Hello intelligent investors, my name is René Zellman, and in my last video I have outlined that we are likely reaching the end of the market cycle and that euphoria is literally off the charts. I mean, just look at this chart. Equity euphoria is at its highest level since the early 2000s. And in addition to that, I discussed why Tesla's current share price is simply unsustainable, and I mainly compared the development of the stock price to the development of Tesla's fundamentals. So if you haven't watched this video yet, I highly recommend to check out this video first. What I want to do in this video is, I will do a reverse DCF to illustrate what kind of growth rates the market is pricing into the stock of Tesla right now. And if you don't know what a DCF is, well, DCF stands for discounted cash flow method. And basically the method attempts to measure the intrinsic value of a business by focusing on the business's cash flows. And it can certainly be considered the theoretically most correct valuation method available. At the end of the day, the value of a company is derived from the inherent value of all future cash flows. And this is what we will take a look at in this video. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, before I get started, please make sure to hit the like button and to subscribe to my channel, because my channel is still fairly new and you would obviously help me out a great deal if you would engage with the video in whatever way. And before I get to the reverse DCF, let's just take a look at some of the valuation multiples of the Tesla stock. Well, according to QuickFS and as of January 11th, Tesla is trading at a PE ratio of almost 1,500, an EV to free cash flow ratio of 830, and an EV to operating income ratio of 460. I mean, honestly, these numbers alone are truly staggering and unheard of, I would say. There's just little precedent for these sort of valuation metrics, especially in the highly cyclical and chronically capital-intensive car industry. In fact, if one would take the industry average PE of the automotive industry, which is roughly 15, Tesla would have to post over 2 times the profits of the top 10 automakers combined to justify its current valuation. And it's important to point out that Tesla is barely profitable as of now. And just to put this into perspective, the top 10 automakers by sales posted net profits of just under $20 billion over the last 12 months. And Tesla's net income over the last 12 months was only around $500 million. And I might also show you the median PE of the S&P 500 index, which is 14.8, which once again underlines how ridiculous Tesla's PE of 1,500 actually is. Now, I'm obviously aware of the fact that Tesla bulls will argue that Tesla shouldn't be compared to other automakers. They would argue that Tesla is a tech stock and should be compared to other tech companies, which generally trade at much higher multiples. But in my opinion, that's just not the case for Tesla. You simply need to take a look at the numbers. Around 94% of Tesla's revenue comes from the automotive segment of the company. So the narrative that Tesla should not be priced as an automotive company, even though its primary source of revenues involves selling cars, is simply mind-blowing to me and emphasizes how inefficient the market and Mr. Market himself can sometimes be. And lastly, let me point out this. With a market cap of around $820 billion, Tesla is now even higher valued than a company like Facebook with a market cap of $760 billion, a highly profitable company. In fact, Tesla has the 6th largest valuation of any stock listed in the United States. That means that Tesla is more richly valued than 494 out of the 500 stocks in the S&P 500 index. And the S&P, of course, includes the most profitable businesses on the planet, basically. And I'm not getting tired of highlighting that the truth is that despite Tesla having a massive market valuation, its business really doesn't produce any significant amounts of cash flows. Alright, before I get to the reverse DCF, let me please know in the comments down below whether you use the DCF method in your research. And maybe have you run the numbers for Tesla yourself? Personally, I have never seen a 1000 PE stock before. Put differently, just to clarify what that means, that's 1000 years worth of earnings. But Tesla bulls will certainly point out that as an investor, you need to value a company based on its future earnings potential. That they aren't buying Tesla for this year's earnings, but rather because they consider the future earnings potential of the business, the profits maybe of the company in 10 or 20 years. And that's a fair point, and I'll give them that. So let's use a DCF valuation model. And for those that don't know, the discounted cash flow method is probably the most accurate valuation estimate that can help you approximate the intrinsic value of any asset based on its future cash flows. So any asset that throws off any cash, obviously. And we can use the DCF model to reverse engineer how quickly a company would need to grow in order to justify the current share price. And that's what I want to do now for Tesla. And just to be fully transparent, I have never done a deep dive on Tesla because I was never really interested in the company or the stock. So I think the firm is operating in a below average industry and selling low margin products. So to be clear here, all of my assumptions are based on my very basic understanding of the firm and the industry. So I would say this is kind of a back of the envelope calculation. And my calculations are certainly not perfect. I might very well get some of my inputs wrong here, and feel free to jump in and correct me if some of my assumptions are just utterly false. And generally speaking, I also want to point out that a DCF can never give you a precise intrinsic value. It's just an estimate based on your assumptions, of course, and your inputs. However, the good thing about a reverse DCF is that you don't have to plug in realistic growth rates to estimate intrinsic value. Instead, all you're trying to do is to figure out what kind of growth expectation the market is pricing into the stock. And for my assumptions, I will use a discount rate of 10% and a terminal growth rate of 3%, which I use for every company. So first we need to figure out how much cash the company generates today. So we will have to navigate to Tesla's cash flow statement and then subtract capital expenditures from operating cash flow. And if we use the TTM numbers, so that's trailing 12 months provided by Morningstar, and do this, we get Tesla's free cash flow. Based on my calculations, I get a free cash flow metric of around $1,832 billion. Now, strictly speaking, Tesla as an automotive company is certainly very cyclical, and I would feel much more comfortable if I would use a more conservative number here and would use some kind of multi-year average. But I'm just going to give Tesla the benefit of the doubt here. And I'm happy to use some overly optimistic numbers to maybe convince some of the Tesla bulls. Moreover, one would actually need to distinguish between maintenance capex and growth capex and only subtract the maintenance capex. But as I've said, this should only be a back of the envelope calculation, and my understanding of Tesla as a company is not good enough to clearly distinguish between maintenance capex and growth capex. So what I have to say here is that I'm more leaning to a conservative number by subtracting the entire capital expenditures. Based on Tesla's trailing 12-month revenue of $28 billion, the free cash flow that I'm going to use for my DCF represents a free cash flow margin of 6.5%, which is compared to other car makers is already above average. We can just take a look at other car makers and see that Volkswagen's 10-year median free cash flow margin is actually minus 2.5%. Toyota's free cash flow margin is 4.8%. Daimler's free cash flow margin is minus 3.4%. Hyundai's free cash flow margin is also negative. Fiat Chrysler's margin is 1.4%. And well, you get the idea here. Ferrari's free cash flow margin is actually 16%. But Ferrari is probably the most valuable luxury brand in the world. So what I'm trying to say here is that I think I'm already quite optimistic here. And I will just give Tesla the benefit of the doubt. So we need to find the number of shares outstanding next. And that's 1,018. And now we need to figure out the growth rates that the market is pricing in. And well, I was just playing around with numbers a little bit here, and let me just show you what I found. Assuming Tesla can grow its free cash flow 60% annually for the next 5 years, and then 44% annually between year 6 and year 10, Tesla's fair value would be $835. Of course, you could tweak the numbers here a little bit, but I think this estimate is sufficient to give us an idea of what kind of growth the market is pricing in right now. Now, I think it's important to point out that we didn't even use a margin of safety yet. If we would use a margin of safety of 50%, I would not be willing to pay more than $415 for Tesla, assuming that I think the growth rates I just mentioned are realistic. And I think these numbers are far from realistic, to be clear. You need to be aware that automaking is a very cyclical, low returning and slow growing business in general. And competition in this space is also about to get somewhat fierce, I would say. Other automakers are already aggressively scaling up their EV business, and they are planning to bring a flood of battery electric vehicles to the market fairly soon. Let me give you some numbers here. Electric vehicle production targets for other automakers include 1.5 million EVs by 2025 for Volkswagen, 1 million EVs by 2025 for General Motors, and 500,000 EVs and 5.3 million electrified vehicles, so that's EVs and hybrids, or half of its global sales, for Toyota by 2025. Now, to be fair, Tesla's 5-year revenue CAGR, so that's compounded annual growth rate, is 50%. However, revenue growth has already started to slow down in the recent years and was less than 20% in the last 2 years. And as a rule of thumb, you want to be incredibly careful when a company has posted very high growth rates in the past. Because as a company becomes bigger and bigger, it becomes harder and harder to keep up high growth rates. And this phenomenon is called the law of large numbers. And it states that an already large company that is continuing to grow rapidly cannot maintain that growth pace forever. At some point, growth rates will decline. And that's why it is crucial that you do not just blindly apply historical growth rates to the future. Exact percentage growth actually isn't needed. Simply use your common sense to determine what kind of growth rates are realistic in the future and to what extent you might have to adjust historical growth rates. So let's just use our common sense for Tesla. Assuming Tesla could continue to grow its revenue 50% annually for the next 10 years. So that's what is needed to justify the current share price, considering Tesla cannot expand its margins. Well, then Tesla's revenue in 10 years would be a staggering $1.6 trillion. You now have to ask yourself if this is realistic and that one can really expect Tesla to grow at such a high rate for the next 10 years. Well, obviously I have my doubts, and just to give you some context here and for comparison, Amazon's 2019 revenue was $280 billion. All right, this brings us to the end of the video. I hope you found the provided information any helpful, and if you liked the video, please share it with your friends and give the video a thumbs up, and of course subscribe to the channel. May your finances and investments prosper. Good luck.